It's time now for the business news then. This week, all eyes are tuned towards the world's biggest tech companies as they report their earnings for the start of the year. Our business editor, Charles Pellegrin, is here for more. Hi, Charles.
Morning, Erin. Absolutely. And the first to post their results on Tuesday were Alphabet, Google's parent company, and Microsoft. Both of these companies performed better than expected in the first quarter of the year, leading to their share prices rising and also leading to a rise in shares for the wider tech sector. Looking at the actual figures, Microsoft and Google both saw revenue grow at a faster pace than what had been forecast. Microsoft saw revenue of over $52 billion, up 7% compared to last year. And Alphabet, saw revenue up 3% at $69.8 billion. The expectation was for little to no growth because both of these companies saw comparatively strong growth in the first quarter of last year. And also because they both implemented cuts in spending over the past few months. Microsoft said it would cut 5% of its workforce, or 10,000 employees, while Google said it would cut 6% of its headcount, or 12,000 jobs. The main driver for growth at Microsoft was its cloud computing business, which highlights that its corporate clients are still keen on digital services, even post-pandemic. For Google, growth came from its ad business, which was actually in decline in previous quarters, but saw 2% growth early this year. Moving forward, though, both tech giants are banking on the development of AI technology and especially chatbots like ChatGPT to drive their growth. Well, the tech sector might be showing resilience, but there are growing concerns over the banking sector in the United States, especially over First Republic Bank. The regional U.S. lender saw its shares plunge 50% on Tuesday after reporting a 40% drop in deposit flights. This is leading to questions on the bank's future. It says it is pursuing, quote, strategic options. The company is reportedly in contact with the U.S. government. Options moving forward could be a rescue organized by larger U.S. banks like the ones that gave it a $30 billion lifeline a month ago, banks like Citigroup and JP Morgan, or for the Federal Deposit Insurance Corporation to take over the institution, which is what happened to Silicon Valley Bank when it collapsed in March. The one silver lining here is that no other regional lenders appear to be struggling as badly. The wider index for that regional banking sector is only down 4% despite the huge losses at First Republic. Sean O'Hara explains why that might be.
I think what to make of the flight from First Republic is that it was another one of these banks, sort of like Silicon Valley Bank, that mismanaged their balance sheet. And in today's world, if there's a suspicion that you're mismatched on your assets and your liability, like Silicon Valley Bank was, with the press of a button, you can move your money. I don't think that it's emblematic or part of a bigger, sort of macro banking crisis.
And let's see how the markets are doing this hour. European markets opening the session in negative territory. The Paris CAC 40 down just under 0.5%. Same for the DAX in Frankfurt. The FTSE in London down 0.2%. This after seeing those banking fears reappear on Wall Street at the close on Tuesday with the situation at First Republic. And we're seeing mixed trading in the major Asian marketplaces as well on similar concerns. The Nikkei in Tokyo down over 0.2%. The Kospi in Seoul finishing the session down almost 0.2%. The Hang Seng in Hong Kong, though, currently trading up almost 0.9%. Now, a costly habit for British American Tobacco. The global company will pay over $629 million in penalties for selling tobacco products to North Korea, violating U.S. sanctions. This is the largest penalty against North Korean sanctions violations ever issued in the history of the Justice Department. Liza Kamenoff has the details.
It's the largest violation of U.S. sanctions on North Korea. Products made by global company British American Tobacco found their way into the Hermit Kingdom. The U.S. Department of Justice said the scheme violated U.S. bank fraud laws.
British American Tobacco and its subsidiary engaged in an elaborate scheme to circumvent U.S. sanctions and sell tobacco products to North Korea through a corporate cutout in Singapore. This conduct, which will be explained more by my colleague Matt Graves, was in clear violation of our bank fraud laws and the International Emergency Economic Powers Act.
Between 2007 and 2017, British American Tobacco sold products to North Korea via a third-party company. The company earned $428 million in trade, the equivalent of 390 million euros, which was then sent back to British American Tobacco via payments made through US banks. BAT allegedly pulled out of the scheme in 2016 due to increased sanctions on Pyongyang, but continued to sell cigarettes to North Korea's embassy in Singapore. Its CEO expressed his regrets for having conducted the business.
We deeply regret the misconduct arising from historical business activities that led to these settlements, and acknowledge that we fell short of the highest standards rightly expected of us.
Smuggled tobacco products are some of the main revenue sources for North Korea's nuclear programs. The country also earned $700 million from trade with a parallel leaf tobacco ring. One North Korean banker and two Chinese nationals smuggled leaf tobacco to cigarette makers, processing $74 million of payments through the US banking system. The three are wanted by the US State Department and have a €4.5 million bounty on their heads.
Well, that's all we have for you for business. Charles Pellegrin, thank you very much.